for that reason, I think they've had a great run, and I'm not sure they're going to have a great run in the future. We always used to say, well, after 15 years, you won't have that competitive advantage because they're all skunks working in it.
How's it going, everybody? Welcome back to another wonderful episode of the Investment Hound podcast. Before we get started, we have three things that we need to talk about. The first is Grandad's book. If you haven't already gotten yourself a copy of Successful Investing, How to Make Money in the Stock Market from Real Life Experience, make sure you go and get yourself a copy today. The links can be found down in the description below. The second thing is to make sure to follow us on Instagram and TikTok at The Investment Hound. And the last thing is, if you have any questions, send us an email on paddy@theinvestmenthound.com. And speaking of questions, Grandad, we actually had a question from a listener from a few episodes ago, which I missed, which from Mike. And Mike says, I love the combo of a young lad learning to invest with his granddad as a mentor. He's a wise man. I assume he's talking about you there. I would ask why he is so attracted to high dividend paying stocks, given the Irish tax treatment is quite punitive.
Punitive.
You corrected me on that actually when I was reading it out to the other day as well. On dividends versus share price against gains subject to capital gains tax with the ability to write off past losses against gains.
Okay, well, I'll give you the answer to that. The answer is this, that if you have a company and the company share price is going gangbusters, going very well, the management of the company get paid very well. They get good share options, they get good bonuses, they get good salary increases, and everybody is happy because the shareholders see their value of their investment going up. And there's nobody willing to disagree with what is a wonderful performance. Now, of course, the performance is in the market. However, if the share price is in decline, then I can tell you exactly what the CEO will say. The CEO, president, or whatever you want to call him, chairman, will say, well, our job is to manage the company. Our job is not to manage the markets. And sometimes the markets have a will of their own, and they decide to drop the price of the company, and there's absolutely nothing we can do about it. So everybody says, well, that's right. I mean, you can't blame the management because people won't buy their shares in the market. So they get away with that on the basis they have no control over it. And they benefit, in other words, from the upside, and they don't take a hit from the downside, generally speaking, unless it gets very bad and very protracted. However, they also pay dividends. And if a company, say, halves the dividend or forgoes paying any dividend, heads will roll. Because the dividend investors expect a dividend every year. People who invest in the markets in the hope that the share price will go up are taking a risk, taking a chance. They're expecting, well, some years it'll go up, some years it'll go down, but hopefully overall we'll be doing fine. But dividend investors are expecting a dividend every year. And if the dividend is cut, that is actually a vote of no confidence in the company. And therefore, generally speaking, the CEO or somebody is going to lose their head. So it's much more likely that dividends will continue than and they're under the control and they're recommended by the board of directors. They're recommended by the CEO. So I feel much more comfortable that if I've got dividends coming in every year, that they will come in every year. And that won't be that, 1 in every 4 years I'll get a dividend and in the other 3 years I won't get a dividend. Whereas with share prices, nobody knows what's going to happen in the future. So I, as an older investor who wants to hold on to the capital that he has. In other words, let's say in this, for example, now we'll end up with 100,000 invested in the markets. Notionally, admittedly, but if we were to do it really, we'd have 100,000 invested in the markets. Now, as an older person, what I want to do is make sure that my successors, my children, and grandchildren even, Adam, right, will get the benefit of that 100,000. So I object to going in and selling shares because I feel that that's the beginning of the sort of, you know what I'll do? I'll go to China on my holidays this year. I'll send a 10 grand worth of shares. I don't want to do that. I want to have an income coming in every month that actually allows me to do what I want to do. And as I think I said to you, recently I had a look to see what the dividend yield on my stocks were. Given that I had X amount of money invested in the market, what does the dividend work out based on what the shares cost me? And it worked out at 8.4% per annum. Now, if I can get 8.4% per annum on the shares, and generally speaking, markets go up, in the round 2 or 3 or 4% a year. Now, not every year, but some years they'll go up by more, some years they'll go up to less, but they'll average that comfortably. So I'm now getting double-digit growth in my, off my portfolio, much of which is pinging into my bank account every month to make up for the fact that I'm no longer on a salary, that I'm on a pension, which is only a percentage of my salary. Then I'm happy bunny. So yes, I pay more tax than it. B, I have the money to pay that tax and some more. So I say to myself, I'm not going to allow tax to run my show for me. I'm going to, because I can be sure of a dividend, I'm going to go for certainty and pay taxes rather than go for uncertainty and not pay taxes or pay lower taxes.
That's a good answer, Grandad.
Okay. But for younger people, can afford, if they're on the full salary, they're not as dependent on their income from investments as older people. So lots of younger people tend to go for the growth stocks and things like that, which older people don't.
So it's, I was just thinking in my head there, it reminds me of when I was doing the loan module for the QFA and the difference between taking out a fixed term mortgage or a variable mortgage. You have the certainty of the interest rate for a fixed term mortgage.
Correct.
So it's a similar kind of concept.
It is. And I have a very simple view on mortgages. If I can fix my mortgage rate, and remember I worked in the banks for 50 years at least, if I can get a mortgage starting with the number 3.1, 3.4, 3.6, then I'll fix it. And I don't believe in fixing it for the shortest amount of time, 2 years or 3 years or 5. I'd be comfortable to fix it for 7 or 10 or even longer. Now, one of my sons, who has 15 years to go before he retires, recently fixed his mortgage with a number starting with 3 until the day he retires. So in other words, he doesn't have to worry about mortgage interest rates for the rest of his life. Because by the time his mortgage interest rate comes up for renewal, he'll be paid off.
I think there's like an underlying concept within this podcast and why we do this podcast, Grandad. It's about taking control of your money, and it's about being the decider of where your money goes and ultimately making money, of course. And I think if you take out a variable mortgage, it makes it difficult to forecast.
Oh, it does. Uncertainty is the enemy of investment, of investors. Investors want something certain. That's why they go into things like bonds, because they above all love certainty. Of course, a true investment is by its nature uncertain. Because you could fix your mortgage at 3 and suddenly mortgage interest rates are 2 and you're kicking yourself. But they're not going to be 2 for very long. That's my view.
But people might be thinking at home then, well, how come we're picking all these different shares to invest in? And as we discussed earlier in a much earlier episode, it's because you enjoy the fun of investing as well.
Well, there's also the issue that if you have a company and the company offers you a share of their loans, in other words, that you invest in the company's debt, their loans, rather than their shares, okay? And if I invest in their shares and that company gets into grave difficulty and can't pay back everybody, the first people that get paid back are the people who have lent money to them. And the second people to get paid back are the people who've invested in their shares. So debt investors are in fact people who are saying, well, I'm not going to go into shares. I'd be happy enough with whatever the interest rate is that they're paying on their debt. However, all companies need people to invest in shares as well as to take over some of their debt. And if shares are a lot more uncertain than debt, nobody will invest in shares unless they can be sure that they get paid the same as the debt investor, plus at an equity premium, a premium that encourages them not to go into debt, but to go into shares. So equities, generally speaking, over time, not today or tomorrow, but over time, will generate higher returns than debt, because otherwise there would be no equity market. And companies need equity investors, because nobody will lend to companies unless there's equity investors sitting between them and the bad times.
Okay. Thanks for the question, Mike. Hopefully that answered your question. So let's move on then. So for all the listeners who have been listening up to date, as you may know, Grandad and I are building a stock portfolio which will consist of 20 different shares. So these are actually the last 2 shares that we're going to add. So currently we have 18 shares in them, and I'll quickly fly through all the different companies. Okay. But if you want to listen to or find out what we thought of each of these companies, make sure you go back and listen to the older episodes. So the first is Whitehaven Coal Limited. We're a mining company. We have CVS Health Corporation, who are a pharmacy. Volkswagen, who are an automotive company. Adecco.
And just hold there.
Yeah.
Whitehaven is quoted in what stock market?
Australia. I don't have all the markets listed up here now.
But the point is that's Australian. The next one is American, isn't it?
Yeah. Volkswagen is German. Adecco, I think, is French, is it?
Swiss. No, but the point is, the shares are quoted in different markets. So in other words, we have diversified our risk across different geographies. That's all I'm saying.
So the fifth one then is Banco Santander, Spanish Total Energies, who do energy. French Sunoco LP, who are energy fuel distribution, is American. We have Ryanair, which of course is Irish. We have National Australia Bank, which of course are Australian. We do banking and financial services. Bristol Myers Squibb, who are US pharmaceuticals. EDP Energias, who are a Portuguese energies producer. Verizon, who are the US telecommunications company. Woodside Energy Group, where are they from, Grandad? Australia?
They're Australian.
We do oil, gas, and coal. We have Emira Incorporated, who do American?
No, Canadian.
We have Alphabet, which is Google's parent company, so American. We have MasterCard, who are American as well, the payment processing. And then the 2 we did last week. So we have Legal and General Group, who are American. And
they're UK.
Oh, UK, sorry, who do insurance. And then we have BASF SE, and I'm trying to remember where they were from. German. Yeah, German. Chemicals for agriculture. So the first one we're going to be looking at today. So these are the final 2 shares are 2 that I picked, and we deliberately picked growth stocks for the purpose of diversification.
When he says we, he means the royal we, because I was not involved.
Yeah, me. Sorry. Yeah. Okay. So the first share we're going to be looking at is a share or a company that everyone knows and everyone has used, that go by the name of Amazon.com Incorporated. So founded by Jeff Bezos in 1994, they're a leading American multinational technology company specializing in e-commerce, cloud computing, and online advertising, digital streaming, and also artificial intelligence.
What's the most important thing they've done in the last few months?
The most important thing they've done. Is this something that was in the news very recently?
Will I tell you? Put you out of your misery.
Okay.
they published Successful Investing, how to money in the stock market from real life experience by the great Paddy Stronge.
They did, yes. Revolutionary to the business operations. So initially they launched as an online bookstore. Amazon has now diversified its offerings to become the everything store, providing a vast array of products and services globally. So let's get into the financials. So their primary listing is on the Nasdaq exchange. Their sector is consumer discretionary, and the sector type is generally cyclical. But as we found out and discussed in the last one, a lot of these larger organizations diversify their business models, which does add complexity to this classification. So its cloud computing division, the web services, and the digital advertising segment have shown resilience even during economic slowdowns, providing more stable revenue streams that are less susceptible to economic fluctuations. So that diversification has introduced defensive characteristics to the company's overall performance. Their market capitalization is 2.29 trillion. So definitely one of the biggest we've looked at so far. And their price is $222.50. And their dividend yield is 0%, which by default makes their dividend payout ratio 0% as well. And their PE ratio is a somewhat respectable 46.67 times. And I say somewhat respectable because of the size of the company. So their income statement, so year on year, Amazon.com Incorporated increased its revenue by 11.83%. The company also lowered its costs, including goods sold, administrative expenses, and debt as a percentage of sales. This led to a significant turnaround, going from 2.27 billion loss to 30.43 billion profit, which is amazing. The cash flow then in 2023, Amazon.com grew its cash reserves by 36.2%, which is about 19.64 billion US dollars. The company generated an 84.95 billion from operations, achieving a cash flow margin of 14.78%, which is great. So the price forecast then, so the 65 analysts on Financial Times offering a 12-month price target for Amazon.com have a medium target of $245. Bear in mind the current price is $222.50. The high estimate is $290 and the low estimate is $180. The medium estimate represents a 12.5% increase from the last year's price target of $217. And then the analysts are rating it a majority outperform with some strong buys, which is good. So then, Grandad, do you want to hear some recent news from Amazon that I've gathered? The first is in relation to NBA broadcasting rights and talent acquisition. So Amazon Prime is set to begin broadcasting NBA games in the 2025 to 26 season to enhance its sports broadcasting portfolio. Amazon,
speaking as an Irishman, up Boston Celtics.
Oh, I didn't know you had an interest in basketball.
No, I went to one of their matches one night and they were all wearing green for Ireland.
Oh, right. And we also went to a Miami Heat game when LeBron James was there.
Yes.
So Amazon is reportedly finalizing a deal to hire renowned TNT broadcaster Kevin Harlan as a play-by-play announcer. Additionally, the company is in discussion with the former NBA stars like Dwayne Wade, who we actually saw, who was playing with LeBron James that night, for analyst roles, aiming to elevate its sports content and attract the broader audiences. So that would be a massive opportunity for Prime Video. The next is in relation to ransomware attacks on Amazon Web Services.
Oh, sorry. Can I tell you also that recently LeBron James played in a top-class game, first-class game, if you like, okay, with his son.
Yeah, Bronny James is his name. Is his son's name.
So I'm looking forward to him playing with his grandson. Go on, yeah.
A new ransomware campaign has targeted Amazon Web Services, with threat researchers labeling it as a recovery impossible attack. So the security incident could have implications for AWS's reputation and may prompt increased investments in cybersecurity measures to protect client data and maintain trust among its consumers or its customers. The next then is closure of Amazon Today services. So Amazon has announced it will discontinue its Amazon Today, which is the same day delivery services, which sourced orders from local retailers effective from January 24th, 2025. So coming up very soon. This decision is part of a strategic move to streamline delivery operations and reduce operational redundancies, potentially affecting customer experience and local partnerships. So, Grandad.
Well, now, just before you go away from that,
Yeah.
Dude, you missed the thing that they're now talking about delivering Amazon. At the moment, they deliver Amazon and Amazon Prime trucks, which are all electric, etc., right? But they're now talking about delivering some Amazon in the centers of cities by foot. Did you see that?
No, I didn't. That's interesting. I know I was reading a book, by a man called Paddy Stronge, Grandad, which is titled Amazon Unbound, which goes on to explain it's basically a biography of Amazon from start to finish. And I know one of the biggest challenges that Amazon have is actually, well, of course, it's not first world countries, but third world countries, because people in third world countries still order packages. And they say, how do you deliver a package to someone all the way out in, the countryside in India? And they actually had to invest in different types of, water vehicles and also motorbikes and stuff like that, because the infrastructure in those countries isn't set up to manage the logistics, so like we have here in the first world country. So I thought that was interesting. So what's your thought on Amazon Inc.?
Well,
Amazon.com?
It's obviously a very fine company.
Yeah.
And the fact that it's closing things and starting things and so on and so forth, that means it has life.
Yep.
And that's a good thing. It's not just sitting there with its arms folded. I mean, the most difficult thing for me in Amazon is the PE ratio of over 40. Now, in the US, the S&P PE ratio is kind of around 18 to 22, somewhere in there. But the NASDAQ is traditionally higher. It could be, sort of 28 to 32. So Amazon up at 40 is an expensive stock. However, as you pointed out, they are talking about, the analysts are saying there'll be a significant growth in Amazon profitability next year. And so it might be justified. It's one that I'm not uncomfortable with for that reason. I'd be uncomfortable with it because I've no dividend. Okay.
Yeah.
But at your age, it could be a good investment, I think.
Yeah.
And it's important, I think, in the portfolio we're building, that we have some of these type of companies in it. So we can actually include those in our analysis, etc., going forward.
Yeah. My perspective on Amazon, Grandad, is that, do I think Amazon will be around in 30 years? And the answer is absolutely. And do I think they'll be bigger than they are now in 30 years? I think the answer is absolutely. I think that beginning to experience a lot of competition from competitors in China like Temu. However, I think the constant expansion, especially in different industries like you have with Blue Origin, that kind of mindset, I think, is attractive for a time range of about 30 years. A long-term investment. Well,
all I can tell you is that when I was working in the bank, and we used to look at, what was our competitive advantages, we always used to say, well, after 15 years, you won't have that competitive advantage, because the market does respond, and somebody somewhere will take them on here, or take them on there, or take them on somewhere else. So I'm not at all certain. They may still be around in 30 years' time, but they won't be going gangbusters, because there'll be enough competitors in there snipping at their heels that eventually they'll be brought back into the pack, if you know what I mean. It's a bit like if you're looking at a cycling race and you see the cyclists, and there's one cyclist ahead, and he's way ahead of all the other cyclists. But eventually they get halfway through the race, and eventually the pack catches up with him. And he just, so I think similarly with business, you can be sure they'll be around, but if they don't innovate and develop and diversify, the current business model won't be have that competitive advantage it has today in 30 years' time.
Yeah, maybe that was a naive statement of me. But I do think they are
Well,
making...
you may be right.
Yeah.
You know, certainly they've done well to date, so there's no reason to believe they won't innovate and diversify and continue to be there. But not in their current form is all I'm saying.
Yeah, that's very true. What do you think of them?
What do I think of them?
You said that you would...
Yeah, I think they're a good investment for people of your age. For people of me who is now 80, I'm not so sure that's such a good investment.
Do you know what, in the book I was reading about them, right? The biggest takeaway from the book was that Amazon isn't an e-commerce platform, or they're not a storefront or anything. Really what Amazon are a logistics operation.
Yeah.
They're about moving one package from one place to another as quick as possible and as low cost as possible. And I think the massive investment, I can't remember what the name of the company they acquired was, right? But they acquired a massive robotics company. And the purpose of that robotics company was that they would use that instead of people in the warehouses. So now in a lot of Amazon warehouses, and you can look up these videos, they're so interesting, but you see all these different, they look like little, the Hoovers that you have in the kitchen, the little robotic, they're like that, except they're just holding all these different boxes and they're flowing so perfectly around each other. And I think that's absolutely amazing. And every time I drive past that warehouse out in City West, I always look over to it and I think, wow, you know what I mean? What an operation that must be to be able to do something like that and build it from a bookstore into one of the biggest companies in the world. I think is just an amazing story.
And AI is what it's all about. And AI is obviously to do with robotics type infrastructure. So they are innovating as we speak. Yeah. And that gives you grounds for optimism.
Yeah. Did you know, Grandad, there's only something like, now this figure might have increased, right? But I think the figure is there's only 56 Amazon Prime planes in the world. So if you see one out in Dublin Airport, that's one of 56 in the entire world, which I think is crazy. And I remember there was one day I was driving Elena out to the airport for whatever reason, my younger sister out to the airport for whatever reason. And we drove past and I saw one of those Amazon planes on the road. I was like, oh my God, one of the Amazon planes. And she was like, what?
But don't forget, it probably does 5 different or 6 different airports,
Yeah.
In other words, they're not there for the day. They're like Ryanair, Ryanair target that on the minimum amount of time the plane should be actually sitting on the runway. And I'm sure Amazon do the same. Yeah.
I would consider myself a little Amazon fanboy anyway. So that's why I presented Amazon as a share for our portfolio. So Grandad, let's move on to the second one then. And I have a very strong feeling I know what you're going to say about this one. The second share, actually it's the final share we're going to add to the portfolio. And that is Tesla Incorporated. So Tesla Incorporated, as a lot of us know, are a leading American automotive and clean energy company founded in 2003, not by Elon Musk, by 2 guys called Martin Eberhard and Mark Taperny, with Elon Musk joining shortly after as a major investor and eventual CEO. Headquartered in Palo Alto in California, Tesla designs and manufactures electric vehicles, battery energy storage systems, and solar products. The company is known for its innovation in sustainable technologies and has played a pivotal role in popularizing electric vehicles worldwide. Granted, I pulled up some 3 interesting facts about Tesla, okay, that might be obvious to me as a beginner investor. Anyways, maybe you might know. But Tesla, would you like to know them?
Yeah.
3 interesting facts about Tesla Incorporated. Tesla's batteries power more than cars. So Tesla's battery technology isn't just for electric vehicles. It powers homes, businesses, and even entire islands. For example, I'm going to butcher this name, right? But Tesla installed a massive power pack system on the island of Teau in American Samoa, making the island almost entirely reliant on solar energy, which is amazing. Similarly, Tesla's megapacks are used in large-scale energy storage projects like Hornsdale Power Reserve in Australia, which has stabilized the local power grid. The second interesting fact is that Tesla owns a secretive research and development lab called Skunk Works. So Tesla operates a highly secretive research and development lab known internally as Skunk Works. The
Well, a lot
facility,
of companies call their innovation location a skunk works. That's
oh,
quite
do
common.
they?
Yeah,
Oh, okay. Why is that, do you know?
because they're all skunks working in it. It's just if you're like, well, how would I describe it to you? As a fond name for the geeks that are in innovation.
Oh,
you know?
okay. I didn't know that. That's interesting. So this facility is rumored to be where Tesla's experiments with next generation innovatives, including advanced materials, AI algorithms, and experimental manufacturing processes. And some believe this is where the Cybertruck's unique and stainless steel body originated. Have you seen the Cybertruck, Grandad?
No.
They don't have them here in Ireland, right? Because they're way too big. But I'll pull up a picture of the Cybertruck on the screen for the listeners at home, okay? But I would encourage you, Grandad, to Google it there whenever you get a second, because it's the most obscure and unattractive looking vehicle. But what's really interesting about it, Grandad, is that it's nearly become a trend for the affluent and the wealthy in America to buy these Cybertrucks. And when people see Cybertrucks driving down the road, the first thing they do is it's like a Lamborghini. They pull out their phone and start recording, okay? So interesting marketing from Tesla. So Tesla's software drives its profitability. So unlike traditional automakers, Tesla generates significant revenue through software updates. So features like the full self-driving are sold as upgrades, sometimes costing over $15,000 per vehicle. So Tesla's over-the-air updates allows the company to improve performance, add new features, and even fix recalls remotely, catching a tech-like subscription model in the automotive world. So they're implementing some pretty interesting, how would you call it, pricing strategies into a very traditional world. Okay, so let's jump into the financials then. So the primary listing is on the Nasdaq exchange. The sector type is automobiles and an energy company. And the sector is automobiles and energy company. The sector type is cyclical. Their market cap is $1.27 trillion and the price is $419. And same as Amazon, the dividend yield is 0% and the payout ratio then by default is 0%. Now the PE ratio, 108.68 times. So as we learned in this episode, the average PE ratio for the Nasdaq exchange is between about 27 and 32, you said?
Yeah.
So they're multiple times above that. So the income statement then, and their beta is 2.35, so quite a high beta as well. So the income statement, so year on year.
Which means the share price is going up and down and over and back and in and out. Yeah, it's very volatile. Yeah.
Very volatile, yeah. So year on year, Tesla Incorporated increases net income by 19.2%, driven primarily by revenue growth from 81.46 billion to 96.7 billion. Although the costs for goods selling, administration and debt rose as a percentage of sales, the 18.8% increase in revenue was enough to boost net income overall. The cash flow. So in 2023, Tesla generated limited cash overall. The company earned 13.26 billion from operations, achieving a cash flow margin of 13.7%. It also raised 2.6 billion through financing, but spent 15.6 billion on investments. The price forecast. This one's really interesting. So the 45 analysts from Financial Times who offer a 12-month price target for Tesla, bearing in mind the current price of Tesla is $419, have a medium target of $286, with the high estimates of 515 and a low estimate of $24.86, with the medium estimate represents a minus 27.8% decrease from the last year's price target of 396. So the analysts then, in the ratings of the analysts, there's mixed results, but the majority as a whole, with slightly more analysts rating it an outperform. Some recent news then from Tesla is in relation to vehicle recalls and regulatory scrutiny. So Tesla recalled nearly 240,000 vehicles due to a rear view camera issued that could impair drivers' visibility. The affected models included certain 2024-25 Model 3s and Model S's, and the 2023 to 25 Model X's and Model Y vehicles. So Tesla addressed the problem with the free over-the-air software update. Okay, so I suppose it's not too bad. The second is tire pressure monitoring recall. So approximately 700,000 vehicles were recalled due to a tire pressure monitoring malfunction that increased crash risk. The issue affected Cybertrucks from 2024, Model 3s from 2017 to 2014, Model Ys from 2020 to 25. Tesla resolved it through an over-the-air software update as well. And then the next is in relation to autonomous driving investigations. So the National Highway Traffic Safety Administration initiated an investigation into 2.6 million Tesla vehicles following reports that the crashes involving the actual Smart Summon feature, which allows remote vehicles to operate via a smartphone app. The probe focuses on incidents where vehicles fail to detect obstacles leading to collisions. Now, of course, they're quite negative recent news articles, but maybe some more positive ones. In 2024, Tesla sold nearly 40,000 Cybertrucks in the US. However, this success coincided with a decline in sales over other luxury models, such as Model S's and X's SUVs, indicating potential internal market cannibalization.
Do you know what that means?
No, I don't know what that means.
It means that instead of getting, an add-on for Cybertrucks, people, instead of buying the normal Teslas, are buying the Cybertrucks. So they're cannibalizing the situation. In other words, they're eating themselves. In other words,
Right.
They're not getting an add-on for the Cybertrucks. They're getting a reduction in the sales of ordinary stuff and an increase in the sales of extraordinary stuff. Whereas what you want is an incremental increase when you bring in new products, not people switching from the old products to the new, which is where they are.
An interesting problem. Grandad,
And that's what cannibalization is, eating yourselves.
Yeah. Grandad, some interesting research from the future plans of Tesla. So one I have here is autonomous driving and ride-hailing services. So full self-driving. So Tesla continues to enhance its full self-driving capabilities, aiming to achieve full autonomy to improve safety and convenience for drivers. And then this one is quite interesting, which is in relation to Tesla Network. So the company is developing an autonomous ride-hailing service, allowing Tesla owners to add their vehicles to a shared fleet, generating income when not in personal use, which is, it's like the modern version of Uber, which is quite interesting. And then, of course, they have advancements in energy storage and sustainability, of course, and robotics and artificial intelligence. And one here, Grandad, that you might find interesting is a Cybercab. Unveiled in October 2024, the Cybercab is a fully autonomous 2-passenger vehicle without a steering wheel or pedals, targeting a sub $30,000 price point with production planned for 2026. What would you do, Grandad, if a taxi pulled up beside you and there was no one in it and there was only 2 passenger seats? Would you and Granny get into it?
No.
Oh.
Would you get into it?
Yeah, probably. Yeah.
Right. Well, you want me to tell you what I think now of it?
Yes, I know what you're going to say.
Well, I'm merely going to say to you that I think, first of all, it's important that we put in shares on a random basis. And you chose those 2 shares on a random basis. You didn't do a huge amount of research. You just said, these are well-known growth company, part of the Magnificent Seven. So what we'll do is we'll put those in.
Yeah.
Okay. And whereas I have some, if you like, respect for Amazon, I find a PE ratio of over 100 for Tesla to be incomprehensible. I think part of the problem is that Musk is now allied to Donald Trump. And I think the Americans have lost the run of themselves. They said, he's now there. He's going to do great, right? And I would never pay over 100 times for a share, because any goodness coming down the tracks is already built into the share price. If your share price, if your earnings, price earnings, if the price is over 100 times the earnings, right? The earnings have to grow 100-fold. You know what I mean? So I think it's crazy. The other interesting thing is, I always look, when I look at, I'm very influenced by the analysts, because the analysts pour over everything. And I don't have time to be pouring over everything. There's a whole lot of guys doing that and talking to the company and talking among themselves and specializing in car finance and so on, right? Why wouldn't they just listen to what they have to say? Now, they actually have said in Amazon, 94% of the analysts that follow Amazon have said you should buy. What percentage of analysts that follow Tesla say you should buy?
Well,
26%. Okay. And of the analysts that follow Amazon, how many said you should sell? 0. And how many said you should sell in Tesla? 26%. 26%. Okay. So effectively, the analysts are giving Tesla a big negative. Okay. Which I would give them, because one of the things we talk about in the book when you're trying to decide what kind of a share you should invest in, the first thing you look at is the business model. And you say to yourself, do I believe in the business model of Tesla? Well, you can now buy in Ireland electric cars for less than 20,000 new. So the whole idea of Tesla, who was the leader of electric cars, that's gone. They're all doing electric cars now. So do you remember I said to you, after 15 years, the competition catches up or whatever, right? They've caught up on the electric side. And Tesla are trying to bring in and innovate new things like the ride-hailing taxi and so on and so forth, right? But they haven't worked yet. So highly risky, very expensive, no dividends, analysts opposed. So I wouldn't buy Tesla. On the other hand, we are trying to teach people who are watching this podcast the way to go about choosing shares. And if we chose all the shares that were brilliant, then there's nothing to talk about. So Tesla is obviously looking at it today is a mistaken buy. However, you'll be glad to know that some of my mistaken buys that I've outlined in the book became great buys over time. In other words, there's no certainty in life. Maybe Tesla will be the great winner. So I think it's good to have one in there which starts with a poor outlook, because it might actually end up with a good outlook, and you're going to learn that there's no certainty in life. And that when you think, oh, I'm definitely going to lose money on this share, you might actually make money on it. So I think it's a good share to have in our portfolio. What do you think of it?
I think it's overpriced. But what I do think is interesting about Tesla is the outlook for the future, because at the end of the day, Grandad, eventually the majority of people driving cars will be electric vehicles, and sustainable energy sources will be the thing powering our Earth. I think maybe in 30 years' time, it could be worth more than it is today. However, you know what I do find really interesting about Tesla, Grandad, is that my perspective on Tesla is that they're the iPhone of the automotive industry. People buy a Tesla for the status of buying a Tesla.
I think that's gone. I think that's gone.
Well, why do people buy them?
I think they're buying less. And one of the problems, one of the reports on Tesla, which you missed, okay, is that one of their big operations is in China. And China, they're starting to lose market share in China. Because Chinese cars can be produced more cheaply than Tesla cars in China. So I think what he has done is he's painted a few wheels and put a star on the top, and Sarah said, here's a new Tesla. And he's trying to see if that will actually encourage Chinese people to buy the cars. But he's under pressure in that big market. And his competitive gain is eroding fast. And I would have said that unless he can get, these new things to work well, and he's running into difficulties with them, he ain't going to justify 108 of a PE ratio. So, for that reason, I think they've had a great run, and I'm not sure they're going to have a great run in the future.
Fair enough. You know what I think is so interesting about the company, Grandad?
Yeah.
Do you know they sacked 40 of the marketing professionals in the States? So now they have no marketing department in the States. They only have a few marketing professionals in Europe. Do you know how many people work in Tesla? 121,000. And they have a few. I couldn't find an exact number, but a few, they said, working in Europe. So for a company to grow that large and not actually have a marketing spend,
I think they're mature now. They're mature. In other words, they're part of the norm now, whereas they were ahead of the norm.
And what do you think about
Would I be more comfortable with the Volkswagen share than the Tesla share? The answer to that is yes, because Volkswagen was down at a low and it's clawing its way back. But Tesla, I think, is good. It only grew last year by 9%. Well, if a company's only grown by 9%, why would you give it a PE ratio of 108? I think they've lost the run of themselves. They believe in Elon Musk being a man that has a silver wand. And I think I've said to you before, there's no such thing as a silver wand. What you require is hard work and smart. Kudos. And I'm not so sure that Elon Musk has those. Now, he's done very well in space.
Yeah.
And I may be proven wrong. But I'm not willing to give him the benefit on the car company.
Yeah, the SpaceX isn't a public company. That's a private listed company.
But it also is relying on state contracts. In other words, on the government giving them contracts. And of course, the government always pays. But that is also a competitive advantage that over time will go,
Yeah, should they have increasing competition from Blue Origin, which are Amazon's branch of what you call it, galactic exploration.
But Amazon's latest foray of sending a satellite up has been postponed. Did you see that?
No.
Yeah. These things take time, and they don't always work out satisfactorily. So am I happy with jolly old Volkswagen plodding along? I am.
What do you think of the move for him to go on and become part of Donald Trump's campaign as a government official? I can't remember what his title is, but...
Well, I suppose he feels, and probably rightly so, that if he has the ear of the president, some benefits will come his way. But probably those contracts. He also is lashing money out right across the world, supporting right-wing governments. Because what, as I think I said to you before, what rich people want is lower taxes and lower regulation. And they are provided by government. So by sitting at the right-hand side of President Trump, he's hoping lower taxes and lower regulations for his businesses. And if you take, for example, the X, which was Twitter, Donald Trump has Truth Social, which is the equivalent of his version of Twitter. Now, he came out recently, Elon Musk, and he said Keir Starmer, the Prime Minister of Britain, had engaged in raping Britain. Raping Britain, he said, right?
Yeah.
Which was total lies and nonsense. But nobody has taken him to court for that. And what X wants is they want total freedom of speech, so that you can say what you want, no matter how hurtful, no matter how illegal, no matter how nasty it is. He wants absolute freedom of speech. And if he gets that approach, and that's what's happening in America now, they're allowing full freedom of speech to both Mark Zuckerberg's company in America and to X in America, and of course to Truth Social. So they're all in this together on that side of the fence. They're all in the business of open media. Like, I was recently involved in producing an article for a Sunday magazine in Ireland, Sunday newspaper in Ireland. And the journalist sat me down and he asked me to prove every single statement I made with independent evidence. That doesn't happen on X. You just put in a statement, have a nice day. In America, that won't be allowed in Europe, but in America, and America is a big market for them. So that's the game in town. And by supporting the right wing right across the world, he's hoping that X will get that freedom of expression right across the world.
So what you're saying, so you think then the business, or the, what would you call it, the unique selling point of X, of no restrictions of what you can say, is bad?
In Europe, in America, they've suspended the requirement to actually, take down things, to look at things, take them down if they're wrong and all that kind of stuff, to suspended all of that.
You think that's bad?
Oh, it is bad, because surely, you shouldn't be allowed to say anything, no matter what.
I think that's the direction social media is going.
It is, yeah.
Because I know
but not in
Mark
Europe.
Zuckerberg.
Europe won't allow that. Like, Facebook won't be allowed to do. He's taken down the checking process he does in America, but he can't take it down in Europe.
But Grandad, it's like from their perspective, it's logistically impossible. Like how many, I couldn't tell you the figure of how many social media posts on Meta platforms go up a second. I would imagine it'd be thousands a second.
I know.
How can you possibly invigilate that without using AI tools or without using some kind of intelligent software to check it? And if you use intelligent software, then of course you're going to be prone to mistakes. And I think that not only puts the people who say things in a bad spot, but it also puts the company in a bad spot in relation to misinformation, disinformation.
Well, I think if the company is doing its best, and if the company is taking down things when they see that they're wrong, that surely is the basic requirement. Now, they may not be able to stop everything going up, but they can take them down quickly once they're up there. But Mark Zuckerberg has stopped doing that now because the regulations have changed.
Well, he said on the Joe Rogan podcast, right? He said that they ran into so much trouble in relation to COVID, okay, because they were instructed by the Biden administration to take down anti-vax and anti-COVID posters or content, okay? Now, they hired third parties to do that, but they also said that a lot of these third parties were then taking down information about naturally building up and organically building up your immune system to be able to fight off these diseases like humans have done for hundreds of years. Some humans have done for hundreds of years.
None of those business people want to be told they can't do what they want to do. And they want to have open access to their media empires for people to put stuff up. Okay? So, of course he's going to object. Of course Elon Musk is going to object. Of course Donald Trump is going to object. Three of the biggest media enterprise things in the world, they're going to object. That's the game in town for billionaires. Reduce any kind of restrictions, any kind of regulations to the minimum. And that's what they want. The people that benefit from regulation are the little people, the people who are badly treated by the big people. I mean, I couldn't take Elon Musk on in a court case because he'd have money to get the best lawyers and he'd spin it all the way up to the Supreme Court. Okay, and my house would be gone trying to follow him up. So regulation helps the ordinary middle class. It doesn't help the billionaires. it stops the billionaires making more money as far as they're concerned. And that's why they want to reduce it.
See, I'm not disagreeing with you, right? But I'm also just thinking of the other side of the argument. If we heavily regulate what people can say online, Grandad, okay, is that not a restriction of freedom of speech? And then if we, let's say I go, do I not have the right to say I think, now not that I agree with this, but do I not have the right to say I think the COVID vaccine isn't or doesn't work, or it's ineffective, or this is a government agenda to, try to get rid of this problem? Okay, let's say. Well, and then that gets taken down. Okay, that gets forced to be taken down by the Biden administration. Well, is that not similar to what happened in Nazi Germany, where propaganda was forced on the citizens and the citizens could not voice their opinions? Is that not a dictatorship organization, and is the modern day society not a democratic, where everyone can voice their opinion?
Well, until, Facebook and Twitter and these things came up, the only way you could speak to the world at large was through the print media or through television. And they were instructed that everything you said had to be factually correct. Okay? So it's only in the last 4 or 5 years, maybe 3 or 4 years, that this idea of being able to say what you want on the internet is in place. We live perfectly happy lives up to then. So I would say to you, there's a balance to be struck. You have to allow people to say what they want to say, but if it's clearly misleading and going to cause damage, it has to be taken down. And that's what Biden was doing. And he is the governor, the government, It's not as if it was you or me telling people to take it down. He's the government.
Now, but it must be made clear, though, okay, that there is a very distinct differentiation between a social media platform and a news outlet.
Is there?
Yeah.
Oh.
Well, the RTE app, RTE are in the social media. They're a news company. Facebook is a social media for entertainment and content, where people can upload what they want to upload. I can't tell RTE, I want to post this.
But there are newspapers with lovely ladies in the middle of them, okay, and sports pages, which are media, which are entertainment.
But it's not.
I can't see any difference between saying something wrong on the paper or on the television and saying something wrong on social media.
Okay. The modern day argument is now that people in my generation get their news from social media.
Absolutely.
So I suppose that is the forward trajectory of where social media is going, It's an uncertain world.
It is.
I think we'll wrap it up there, Grandad, will we?
I think so.
We could probably go on about this debate for hours, and I'm sure the listeners at home have a lot of interesting things to say about this debate. Make sure you comment down below what your thoughts are on all the topics we've discussed, because we're very interested to hear what the people at home think about what we say. Are we rambling on, or are we making sense? That's for you to decide. Ladies and gentlemen, this has been the Investment Hound podcast. Thank you very much for listening. Make sure you go and grab yourself a copy of Grandad's new book, Successful Investing, How to Make Money in the Stock Market from Real Life Experience. If you're watching this, you can see it above Grandad's head there. It's available on Amazon, and the links can be found down in the description below. Also follow us on social media. Instagram.
Where you'd only get the truth.
On TikTok and Instagram at The Investment Hound. And if you have any questions, shoot us an email at paddy@theinvestmenthound.com. Any final words, Grandad?
No, just what we now have to do is look and see what kind of a portfolio we have and start to discuss what we do about that.
Yeah.
So we're going into the second leg of our journey now.
Yeah. We're off camera. We're going to need to map out the logistics of how we're actually going to do that.
Yeah.
Because that's going to be a challenge. But we will do that for you, the listeners at home. We always go the extra mile here at the Investment Hound. So thank you very much, and we will see you on the next episode.